Talk Wealth webinar. Today we're going to cover income investing. There's a lot of different ways to collect income in today's world, and we're going to touch on three of our favorite, but we're going to look at many and try to give you an overview of what to expect, both near term, long term, and how to think about your the risk that you're taking within the investment landscape, so that you can make the most of your capital, earn the best income while maintaining the appropriate risk. So we're going to look at that. I'm Justin Klein, CEO of KPU Financial. This is Jason Toper. He's the CIO. He handles a lot of our fixed income trading. So he's going to talk a lot about that. And this is our agenda for the day. We're going to look at the current and future macro backdrop, which is obviously very important and very volatile currently, considering the Fed's path when it comes to rates. We're going to cover dividend income, which is a lot of people's favorite way to get income, fixed income investing, and then selling options for income as well. Now, the inflation outlook is clearly slowing, right? But there were a lot of supply chain issues during the pandemic, and there was a lot of spending. So obviously QE from the Fed, low rates, and then governments going out there giving checks to people, PPP loans that really were more like gifts to corporations to quote unquote pay employees, keep them employed, etc. But it was just a sign of the times that governments, in the face of all types of economic challenges, they're going to turn to extreme resources, and that is the purse of the government, which we'll get to in a little bit. And there's limits to that, but they're not quite there yet. But that's really what drove inflation. We'll look at some charts there. Now, there were supply constraints, obviously, shutdowns globally, because we have a globalized world and globalization has taken over. But as you'll see, that's shifting a bit as well. Now, demographics are also a big factor here, because especially in places like China, demographics are getting a lot worse. Here in the US, not quite as bad. We're not fantastic, but we're better than a lot of the developed world. So demographics means, hey, there's less workers, less available workers going forward. And obviously that is inflationary over the long term. Then lastly, geopolitics, obviously with the war in Ukraine, and then our increasingly more hostile relationship with China. Right, there was a bill that was just announced, bipartisan bill to ban TikTok, which is, I think, probably going to pass at some point. You have the CHIPS Act that really prevents our best minds from working in China on high quality, high value add chip manufacturing. And so all of this together makes it look like a world that is now deglobalizing, more regionalization, and that's really what's driving more the long term, right? Supply constraints are long term. Geopolitics, those are long term, but obviously the M2 and money supply and government policy, that is ebbing, right? That's more short term. That's going to be very erratic, and that's what you should expect. Now, this is M2 growth, and this goes back all the way to the 60s. And what you can see here is that it's clear. The purple line is M2 money supply year over year. So M2 are basically cash in people's bank accounts, money market accounts, basically liquid assets that people can go spend. When they have a lot of liquid assets, what do? They go and they spend it. And that obviously creates an inflation. And you can see that the orange line is the CPI. And there's a lag effect here, but whenever you have high M2 growth, pretty much you soon follow with high CPI. And you've seen that recently, right? Look at the purple line, the M2 growth, hit near the highest level year over year growth that we've ever seen by far. I mean, the last ones were in the 70s, and that was in the low teens. We went into nearly 30%, 27% or so year over year by the end of 2020. And that's why we have this high inflation. But what's happened, you can see, is the opposite. Now we're all the way down to 1% growth year over year. We might go negative. We haven't been negative since the early 90s. And so that means, guess what? Inflation is going to come down. That's why you saw the inflation figure for the month of November decelerate, and that's going to continue to do so throughout the year. Now, a lot of this M2 growth is because of government transfer payments, and you can see those huge spikes, but it's come back down, but it's at a higher plateau. And a lot of it has to do with Social Security. People are retiring, people are collecting Social Security, especially the baby boomers, and that means that less people out there to work. And that's why you, which I'll get to, let me go, labor supply. I'll go back to this other one, but here's the labor force participation. It was around 63 before the COVID, 63%. Now it's down to 62. And 1% doesn't sound like a lot, but remember, our working population, working workforce is about 200 million people. That's 2 million people that are not in the labor force. They are probably retired. There's acceleration of baby boomers retiring, and that is one of the big reasons why government transfer payments continue to go up. You also have more disability payments, etc. So all of this is lining up to a labor situation that is going to be tight for some time, even if we go into recession, which we're likely to be in a recession sometime in the early middle part of next year. You're not going to see sky high unemployment, which means that the pressure on inflation is going to remain relatively robust. Now, going back to the backlogs and the supply, or the difficulty to deliver things during the pandemic, you saw that spike. This is the ISM Manufacturing Backlog Index. So that's cratered as well, which means that the whole idea of, oh, I can't get things anymore, that was last year's story, end of last year. It's the backlogs are cleared for the most part. We're actually below levels than we were pre-pandemic. So that's no longer an issue, at least in the near term. Now, the commodity index, you can see this goes back to the pandemic, and it fell during the pandemic and then rallied consistently throughout, despite the dollar being relatively strong. So that's something of note. And this is pulled back on a really strong dollar, but you can see it's still in an uptrend. And this means that longer term, with what's happening in Russia, when the fall of the Soviet Union happened in the late 80s, early 90s, all of those oligarchs that made all that money, they didn't make that money by selling products, selling their wares, really their commodities to people and companies within Russia. They exported a lot of that throughout the world, and that's why through the 90s you had very, very low commodity prices, and that contributed to disinflation for 20 plus years up until now. Now we have a war, they're cut off, and it's going to be more difficult for them to export. They're still doing it in some ways, but it's going to be more difficult, continue to be more difficult going forward as long as they're a pariah state. And I don't know about you, but I don't think that's going to change anytime soon. So the commodity index, that's going to continue to put pressure on inflation upwards. The inflation picture is moderating. So this is month over month, and what the dark blue line is the core goods. Okay, so goods inflation, and you can see for the last 2 months it's been negative about 4% last month in October, and about 6% last month. And you see the shelter, which is the light blue, that is excuse me, that's the medium blue. That one remains relatively high, and that's a lagging indicator because it's all about rents. Shelter measures rents, and rents, if you signed a lease in March, well, that lease is still here, it's still going, right? But that's included in the shelter inflation. So it takes a while for those new leases to be signed and for the shelter part of the CPI to continue to come down. And on the services side, that's where there's a lot of labor involved, and so that typically is stickier, higher. And it's probably going to be, but that's still moderate. It's only down to 1 or 2% year over year. So if you go ex shelter, we're kind of in a disinflationary environment. So inflation, for the most part, is dead. The Fed isn't really getting that picture, but that's where we're at right now. Now, here is inflation versus deficit and GDP. And what you can see here is that the purple line is the deficit. You see that blew out back in the 40s during the World War II, understandable. And what you see is through the 60s and 70s and into the early 80s, what you saw is this, look how high the CPI was, and look at the deficit. The deficit is kind of around the flat line, flat, -1, -2%, but inflation, especially in the 70s, that picked up dramatically. And so what that allowed the government to do is to inflate away the value of the debt. And that's likely what they're going to do going forward. So right now, this is projections for about a negative 4% deficit for the foreseeable future for the next few years. Now, that doesn't include if we're going to go into recession. I think this projection is to 2027. So, go into a bad recession or a mild recession, that's going to blow out a little bit more. But the main point of this chart is to show you that the government is going to need to inflate away the debt. And you can see this with the debt to GDP ratio. We're at 134%. That doesn't include entitlements, Social Security, Medicare, et cetera. That's obviously hidden liabilities in the balance sheet as people retire. And tax receipts. Tax receipts are really high right now. You can see the red line, that's federal government tax receipts. And then the blue is the Wilshire 5000, so equities. And typically it follows. Once equities fall, and this is year over year, and you've seen that, we know now that equities are down year over year, tax receipts are going to crater. And that's actually what's happening here in California, where a massive surplus is now turned into a deficit very quickly because there's not, the Silicon Valley entrepreneurs aren't selling their stock for huge gains and paying huge taxes anymore. And so this is going to put pressure on government deficits. Now,
the next question will be, is how high can rates really go? This is the federal government's current expenditures on interest. And with a roughly $30 trillion deficit or amount of debt that's outstanding of the government, every 100 basis points is $300 billion annually we're spending on interest. And so when you go from paying 1 to 2% on average that we have over the past 10 years or so, and you start paying closer to 4 or 5%, suddenly you're going to go well above $1 trillion in annual interest on our debt. And you add that with our entitlement spending, and our fiscal situation gets pretty dire pretty quick. And so it's unlikely that the Fed is going to be able to keep rates sustainably higher and go even much higher than they are now. And that's why part of the reason you're seeing the market price in lower rates going forward. So while we think rates are going to go up, less of that will have to do with the Fed actually raising rates significantly, and probably more will have to do with markets adjusting to a higher interest rate or higher inflationary environments. Excuse me. Now, here's the interest expense on to GDP, and you see how low it's been. While our debt has gone up because of the amount of QE and low interest rates the Fed has been stuck at for the last decade plus, our overall burden of debt or interest on that debt has been relatively low. But as you see, it's starting to tick up, and their ultimate goal is to keep this relatively low. They can afford, the government can afford the interest expense to go up a bit, but only if GDP goes up as well, because GDP drives tax receipts, and you want those to grow proportionally. And that's why I always say the Fed are likely to be on a path of keeping interest rates lower than the inflation rate, so negative real yields. And that's how they inflated away the debt back in the 60s and 70s and 50s, post World War II. And that's likely the path forward. And that's another reason why inflation is likely to remain elevated for some time.
and the last thing I want to touch on is really industrial policy. You see that with the CHIPS Act. This is the first major of my lifetime, really since the 60s or 70s, when the government has created some sort of major industrial policy that's going to uh, bring jobs back and not outsource jobs anymore. It's about bringing jobs back to America. And frankly, that's going to be inflationary. If globalization is inflationary, it's natural to expect deglobalization or regionalization to be more inflationary. So what is the cause and effect? Well, the Fed is shrinking their balance sheet passively. That's what the inflation has caused. And the effect will be is the bond market is now pricing in rate cuts by the end of next year. So the Fed is they were behind the curve, and now they are not paying attention to really the signs that we're going into recession next year. They still think we could have a soft landing. It's going to be a recession. It's just a matter of how bad it really is going to be. Now the Fed has raised rates, banks tightening lending standards. That's typical, and the goal is to reduce the demand in the economy. Employment is obviously weakening, and we're going to show you that here. So this is QT, right? So this is the purple line is the balance sheet of the Fed. The orange line is interest rates. So you can see what they're doing, drawing down their assets a bit, but not very much in the grand scheme of things. Pretty minor. It's really been raising interest rates. Now the yield curve is inverted, and typically what you see here is the longer dated treasuries, which are the blue, the green, the purple, or excuse me, the pink. Those are the longer dated treasuries. So 10-year is the pink one. And what you can see is earlier in the year, the longer term ones were well above the rates on short term. Short term is that purple, the 3-month treasury. But around September, October time, that started to invert in a big way. And now it's definitely inverted. That's basically what the bond market is signaling is, hey, the Fed is going to have to do a U-turn. It's probably sometime in the next year.
You know what's interesting, Justin? Jerome Powell said in the FOMC meeting that he was going to put rates up to about 5.1%. But what the market is expecting, he's only going to get to about 4.3 to 4.4%. So the market is projecting that even though Powell's saying we're going to get to 5.1, it's saying, no, we're not going to get that far. And actually, towards the end of next year, we're going to think about cutting the rates.
Yeah, I think that's important to point out. The bond market is usually not wrong.
Yeah.
They understand the economy much better in aggregate, better than a group of 12 academics on in the Federal Reserve. So
right.
So they're typically behind the 8 ball both ways, right? They're too late to tighten policy. Last year when they were talking about transitory, clearly it wasn't. If they paid attention to the M2 growth, which you just showed you, they would know that inflation is going to continue to accelerate. But now you look at all the other factors, and the bond market is telling you, hey, you should stop. Even Jeffrey Gundlach said today, hey, when you see that the 3-month or the 2 years well below the 3-month, that's a clear indication. And go back here. This is the 3-month is the dark purple, so that's up about 4.28%, and the 2-year, the blue, is at 4.3. So it's kind of flat, but the 1 year is a little higher. But yeah, so now you're starting to see after this is before the Fed meeting, but now since the Fed meeting happened, this is now inverted because those longer term rates have dropped a bit, whereas short term rates have kind of stayed static.
And it also takes a good 6 months to a year for the rise of rates to work itself into the system. So Powell has been pretty aggressive towards the latter part of this rate cycle. And so, we're going to have to see in 6 months to a year what the effect that he's just done in the last few months has on the economy. And most likely, the market is predicting a mild recession. I would say we're probably going to be a little bit more on the deeper. I don't think it's going to be a soft landing from what I see of the aggressive rate hikes and tightening of money supply.
Yeah, I think the real question is how well will the strong balance sheets of consumers buffer any downturn in the economy? Because there's a lot of money in people's pockets, right. And people paid off debts, and that's starting to reverse, and they're working through that. But they're probably not going to work through it until the middle of next year completely. So they still have some money in their pockets, and as more people are retired, they are collecting Social Security, so they have some income. And unemployment, while rising, is probably not going to rise, I think, a dramatic degree. So I think we're going to have probably a little bit worse than our 2003 recession, but not as bad as an 08 recession.
No.
Right. So kind of in between the two. Now, this is the bank tightening lending standards. So what happens when the yield curve inverts, banks start to tighten their purse strings, and they lend less because their cost to borrow typically is higher than what they're getting on their loans, which are a lot more long term. And you can see this goes back all the way to 1990. But the orange line, when that goes down over 100%, basically means this is a percentage off the high. So 100% is basically going from wherever the high was to zero, right? So if this goes beyond negative 100%, that means the yield curve is inverted. And what you can see is anytime that happens, what banks start to tighten lending standards. This is net percentage of domestic banks reporting tightening loan covenants for large and middle market firms. So when that goes up, that means, hey, banks are tightening their standards. They're not lending as much. And that happens soon after the yield curve inverts. And what have you seen recently? The yield curve has inverted. 3-month 10-year. Everyone talks about the 2-10, not nearly as important as the 3-month 10-year. So that's kind of where we're at right now, and why we do expect a recession in the early middle part of next year. Now, employment trends have turned. The U.S. continuing claims for unemployment insurance. So it's not just how many people are filing for unemployment. A lot of people look at that as, the new claims for unemployment. Well, that doesn't matter if you file for unemployment and a week later you get a job. That's not really that bad, right? You got to work for a week or two, no big deal. It's about who's staying on the unemployment rolls and can't find a job. And you see that as of September, October timeframe, that started to go in an uptrend, and now trending back towards that 2 million mark. And I think that's where you get into trouble in the economy, when that starts to hit about 2 million. Now, what does this mean? This means that inflation is going to remain relatively persistent. It's going to come down near term for most of next year, but it's going to level off at a higher level, probably 3 to 4% is what it's going to stay at.
Now, the big question a lot of you are probably trying to find the answer to is, how will all of this impact various asset classes? And this is a regime that not many people are used to. Even if you were invested in the 70s, it's going to look a little bit different than that. Some similarities, but more similar to 50s and 60s than the 70s. Because inflation is not likely to accelerate dramatically higher, meaning double-digit plus. Everyone talks about hyperinflation. That's unlikely to be the case. It's going to be just more higher elevation of inflation than most are used to, if you're looking at the recent history of markets and economies. So what asset classes will do well? Well, every asset class in a way is bifurcated. There are certain parts of those asset classes that do well in different inflationary regimes, different economic regimes, and equities are different. So what you want to be is overweight companies that are producing consistent cash flows and profits today, meaning short duration assets. Remember, short duration is you're getting those cash flows and in the immediate term, this year, next few years. And too often over the past decade plus, everyone's been invested in exciting names where the prospects of domination of a particular part of the economy, part of the market, is many years out, 5, 10, 15 plus years away. And actually, those are long duration assets, and that's why they did so well, right? Cost of capital is very low. If you're burning cash, no big deal, because liquidity was abundant. It was easy to get new money, issue shares, borrow money, etc. That's no longer the case, right? The cost of capital is going higher, and so you want to be underweight companies with those negative cash flows, with high multiples, the long duration type of equities. So that's what we say. This is a new market regime, and it's flipped from what most are used to. Then on the bond side, you want to be overweight short and intermediate term duration, so not going out too far, and you want to be taking some credit risk. Why? Because as prices across the economy go up, it's going to be easier to pay off those debts that were issued when prices in general were lower. And so that's one reason why you haven't seen credit spreads widening out as of yet, is because those higher prices across the economy means that companies, even if they are marginally great companies, their profit margins are relatively steady over time. And if prices in general are higher, their total profits are going to be up. Their cash flows are going to be up. And so you want to be overweight those, once again, short duration assets and taking a bit of credit risk, which means you should be underweight the long duration, long term, 15, 20, 30-year type of bonds. And you want to be underweight low credit risk, so basically government bonds. I talked a bit before about how they're likely to remain, government bond yields on a real basis after taking out inflation are likely to be negative. And so you don't want to be in those type of assets. So TLT is a good example, down huge from its highs last year. and you want to be, and that's rare, right? Treasuries to be steady. But when interest rates are low, or the coupon's low, and suddenly rates rise dramatically, that duration risk really hits home. And most people haven't been used to that because they've been used to interest rates remaining low. So that's equities and bonds, probably the areas you are most focused on to produce income, but there are others as well.
Fixed income expert.
So we're going to talk about, over the next few slides, some fixed income opportunities, ways to invest in fixed income assets. And so I went too far.
There we go.
Okay.
I fixed it.
Back a little bit.
Right. Here,
Okay, so I created a list of all the investment fixed income vehicles that you can invest in. And from top to bottom, we're going to go from low risk to high risk. So treasury bills, as of this year, they were a terrible asset to have in your portfolio. Last year, the 2-year treasury was half a percentage point. So why would you buy something that's half a percentage point?
especially inflation.
Yeah, you're losing money. Real time, you're losing money. But now we got 2-year bills going for 4.25, 4.3 for 2-year risk-free rate. That sounds pretty good to me. The 10-year is around 3.5. I'd much rather have the 2-year over the 10. Obviously, the market is forecasting a recession and lower rates in the future. CDs, certificate of deposits, those are issued by banks or credit unions. Those rates are right around what the 2-year treasury is. It's about a 4% or so. Problem with CDs is they lock you in, but you can stagger them. You can go from 28 days up to 10 years, depending on what type of CD that you want. But for a comparable to a treasury, 2-year treasury, I probably would have the treasury over CD. Money markets, those are offering right now about 2%. Those are great vehicles just to park your cash and wait for the opportunity in the market. But 2% is a lot better than 0.
But in your savings account,
a 1/10% last year.
Yeah, but it's it's going to be low yielding and very liquid.
It's liquid, so that's why you have it.
But you're not locking in. If the rates start to drop, then the yield in the money market drop.
Yeah. Next one we have is municipal bonds. These are state and local bonds issued, and
they're typically only good for if you're in a high tax bracket,
such as California.
Yeah.
They're great
or if you have a high income. If you're relatively low income, their yields are so low that tax adjusted, they're not that great. But if you're in a high income tax bracket, it can be advantageous.
Exactly. So when you do your research and compare, well, should I own a municipal? Should I own a corporate bond? You're always going to want to see what that tax equivalent is, and you're going to want to purchase the one that has the higher yield. Fixed annuities. So annuities come in 2 flavors. You got your variable, you got your fixed. We never say to go in. We never recommend anything about variable annuities. Fixed annuities, there's a time and a place for them. You just have to understand that there are surrender fees. It's a very high fee type of investment vehicle that locks you in. But as you approach the high end of the rate cycle, that would be maybe the opportunity to get into a fixed annuity. They are guaranteed by the insurer, so it's a lower risk level.
So fixed annuities can be good for certain people. It's still rare.
It's rare,
but variable annuities almost never a good idea.
And then we're down onto the corporate investment grade. So we've got investment grade and we've got high yield. And these are debt instruments or debt securities offered by corporations to fund expansion.
Fund
operations and expand property, plant, equipment. So the difference between the two is just how stressed the financials are of that company. High yield tend to have worse fundamentals than investment grade. So you kind of have to do your own due diligence and research if you are going to go down into that junk level, high yield. And then the next one is bond funds. So these can be offered in closed-end funds. These can be offered in ETFs, mutual funds. It's just a basket of bonds put together. The opportunity with bond funds, once again, when you're at the high end of the interest rate cycle, closed-end funds, if you get a panic in the market, a lot of times they can be sold on discounts from the net asset value. So that could be a great opportunity to get in there, buy when there's panic, blood on the street. And then when the dust settles, usually those prices go right back up to that net asset value, and you get to profit on that fear.
The biggest risk, I think, of the closed-end funds is a lot of them are leverage,
Mhm.
right? So they look like they're good because they might yield 7, 8, 10, 12%, but that's because you're taking leverage. And you've seen probably a lot of them have come down right now 40, 50% because you have interest rates going up, bond prices going down, they're levered, and suddenly those losses are now magnified. And so it goes both ways, cuts both ways.
Right.
Leverage in general always cuts both ways. So you have to be cognizant of that risk when you're searching and you're stretching for that yield. You have to be prepared for that volatility.
Exactly. And unfortunately, if you were to buy a bond fund last year when rates were very, very low, those prices have depreciated in those funds significantly. And these funds, they trade bonds in and out. It's not like you hold the bond outright and you can hold it to maturity and get your money back. If you bought a bond fund last year, it's come down so much. Unless rates go back down to where they were last year, those bond funds are never going to appreciate back up to that height of what it was last year. So you got to be really careful in timing when you get into these funds.
Yeah.
The next two are private placement REITs and debt and equities. These are pretty illiquid type of instruments.
So a good example is the Blackstone REIT, B-REIT, that just closed they just gated redemptions. So
yeah, what they did is I think they capped it. They said, hey, we only will allow 2% to be redeemed of outflows of our funds. Once we reach that, you're going to have to wait till the next quarter. And everybody's forecasting that next year real estate prices are going to go down. Hey, I want to take my money, I want to put it somewhere else. I do not want to be in that sector. And so they're getting a flood of people who want to take their money, and they're saying, nope, can't do it.
Yeah, and a lot of times you'll get a statement saying it's done this well over this time period. But we've seen over the history of these private placement vehicles, whether it's a REIT or a private equity fund or whatever, is what they quote you is not really what you can sell it at once you do want to. So be careful with them. We always say avoid them because you can find just as good, if not better, opportunities in the public markets, and you don't have to pay an extra layer of fees, which there's just like variable annuities. There's a lot of fees that you don't really see.
Low fees and liquidity.
Yeah.
Now, what factors influence bond prices? Well, the first is obviously that the price of bond moves inversely to interest rates. So if you have a bond that you buy, a company issues it, it's yielding 5%, and a year later, the prevailing interest rate for that type of company is now 6% in the marketplace. Well, your bond, right, the coupon is going to stay 5% of the original purchase price. But to adjust to that new level of interest rates in the marketplace, the bond price has to decline so that the current yield to maturity of that bond is closer to 6%. So that's why bond prices are inversely correlated to interest rates. And then there's credit rating. So whether that credit rating is upgraded or downgraded, that's obviously going to change the way the market is pricing the risk of default in the bond. And that's certainly important because, as you've seen, the higher the chance of default, then you should expect higher yield, and the bond price has to adjust to that. And there's a lot of risk where in the investment grade world, there's a lot of triple B type of bonds, rated bonds. Some of them maybe should be rated a bit lower, maybe double B. And if they get downgraded double B out of investment grade into junk, then there's a lot of funds that can only invest in investment grade bonds, and they will automatically sell it. And so that is, I wouldn't say a cliff, but definitely something to consider when you're looking at bonds in general, is which direction are they likely to be upgraded or downgraded. So the opposite could be true. You go from junk, double B, and you could upgrade it into triple B. Hey, suddenly you have a much larger universe of buyers that could potentially buy those bonds, and those bond prices are going to go up. And so that's definitely something you have to be aware of when you're buying bonds, is what type of credit risk are you taking. Now, bond maturity, that's important as well. So we talked about duration risk before. Long-term maturity, they're more sensitive to interest rates. Like I said, with TLT, those long-term duration bonds, those are going to be more sensitive to movements of interest rates. Then the coupon rate. If the current coupon rate is lower than the prevailing market rate, maybe it was issued 5-7 years ago when interest rates were down in the dumps, and the corporations took advantage of those low rates and as a very low coupon. Well, those are going to be more volatile because you can't take that coupon and reinvest at higher rates, for example. And so that is a factor as well. So longer duration, low coupon, those are the ones that are going to be most sensitive to interest rate changes. Now here's credit rating, and you see here this is the investment grade universe, so triple B or triple B minus all the way to triple A. That would be investment grade. The junky part of the market, the junk market, high yield market, that's double B plus all the way to C. D is default, or C on the Moody's is default. But they're not all created equal. You definitely want to stay in the high end double B plus of investment grade because the default rates increase exponentially as you go down in the junk category. So be aware of that. Now, our sweet spot, what we like is kind of that triple B, double B plus area in the 3 to 5 year part of the curve because we have an inverted yield curve and you actually have declining yields as you go out further. So you're still getting nice 7.5% yields in that corporate bond space. And it's always nicer to buy individual bonds if you have money over the bond funds, if you can.
So now that we kind of have an understanding of how bonds work, now where are we in the cycle? Are bond prices going to decrease or yields improve? One way to look right now is at default rates. And in the last 10 years, the default rates have been extremely low, historic low. It's been roughly 1.5–2%. That is not average. And so because of that, the market is not assessing the risk to owning some of these high yield instruments. Well, a recession's coming. There's going to be more stress on financial balance sheets, and you're going to see a lot more companies go under. When this starts to happen, you're going to start seeing yields go up with bonds because investors are going to want that reward for taking the risk of, hey, maybe something now in my portfolio is going to go under. I need more return to have that.
Yeah, it's called yield spread. So yield spreads are likely to widen out, which is.
Can you go back? So on average, after the past recessions, the default rate has gone up to 12%. Now this statistic came out from Deutsche Bank. They're expecting roughly a 10%. I think we're probably going to get to around a 7 to 8% default rate. One of the reasons why, if we go to the next slide, this is the debt to equity market capitalization. And although there's a lot of debt that's out there, if you compare it to the market capitalization, we're pretty low on the low end. So
companies can issue shares if they get in financial trouble.
Exactly. Right? Yeah. There's two conclusions. One is, you can do secondary offerings, and that can help these companies alleviate the financial stress when we go into that recession. Hopefully, they'll stay around and then come out of the recession, and the revenues and margins will come back. The second conclusion is, for this to go back up, either corporations are going to issue more debt, which they're probably not because cost of capital is so high now. Most likely, equity markets are going to come down, and that's going to drive this price up. So this kind of shows me that, hey, maybe we're still going to have some pressure on equities. The bottom may not be set in yet. So it's just kind of something to think about when it comes to the equity market. And so the last thing here is the credit spreads. Right now, we've got a credit spread of about 3%. So what is a credit spread? Credit spread is the difference between what your bond is to the risk-free rate. So let's say the 10-year treasury is at 4%, and your bond is paying 7%. Your credit spread is 3%. And this kind of shows you the history of credit spreads, and these gray lines are previous recessions. And you can see it can, back in the financial crisis, it got up to 15% credit spread. So that means you could have bought a bond that had a 20% return. I think we're probably going to get up to about a 5 to 6% credit spread. So previously, when we saw the sweet spot of like a 7%, add another 3% to that. And so that's kind of where you can forecast what bond yields will be in about 6 months to a
Yeah,
year.
because typically what happens is, especially near the end of a recession, is the Fed's cutting rates, but because there's financial stress in the economy, these bonds, these corporate bonds, yield spreads are widening out. So it's while right now you could see the 10-year and Treasury rates stay flat or go down, you can still see yield spreads widen out and the corporate bond market get even more attractive. So that's probably what's going to happen next year. Now let's get into dividend income. I'm going to try to make this as quick as possible, but basically there's some benefits to dividend income. One is it's passive. You can grow that income over time, which a bond does not do, obviously. You can pay a special dividend, which people, that happens from time to time, especially companies that are very well run and they're positioned for shareholders above all else. Qualified dividends, so taxed at a relatively low tax rate, 15 or 20% for most people, versus the ordinary income tax rate, which comes from REITs and master partnerships. That's one consideration you have to go over. You can have capital appreciation. There are bonds. There's capped on really how much appreciation you can get. You can set up drip campaigns, so dividends come in, they're automatically reinvested. But the drawback is you're going to expect more volatility. Bonds, although they've been volatile this year, is kind of an anomaly. All right, so the stocks can be a lot more volatile, and you have to be prepared for that. They can cut their dividend. Bonds, right? They have to pay that interest rate, otherwise they default. Yep, exactly. Whereas any company can eliminate their dividend at any time. Double taxation. So companies are taxed at the corporate rate, and then you're taxed when you receive that dividend if it's in a taxable account. There's dilution. You could have companies issue more shares and dilute the shareholder, and then slower company growth. So if they're paying out a dividend, that's less money for them to go and reinvest in their business. And like I said, make sure you understand this with REITs and master limited partnerships. These are not qualified dividends. So you might see a nice 6, 7, 8, 9% yield. You have to understand the tax implications, and you don't want to own master limited partnerships in tax deferred accounts like 401ks, IRAs. If you earn over $1,000 per year, you have to file a separate tax return. It's a big pain. So you get K1, and it's no fun. Now, the good thing about dividends is they typically keep management disciplined, because when you don't want to be the management team that runs the company so poorly that you have to cut the dividend. It's not something that most managers want to see. Now, what are the metrics you want to look for? So from a valuation perspective, you want obviously a high dividend yield, but it doesn't need to be too high. Enterprise value to EBITDA, you want that lower. So enterprise value is important because it incorporates debt and equity on the company balance sheet. And EBITDA is more of a cash flow measure, so that's a good one to follow. EBITDA to sales ratio, that is what are their margins, right? What is their cash flow margins compared to their sales? You want that that ratio to be relatively low. Enterprise value to free cash flow, so how much is the company, how much is the market pricing in for every dollar of cash flow? How much are you paying? So you want to be looking at those. Dividend safety, so this is the payout ratio. So dividend per share divided by earnings per share. It can be a little bit misleading because earnings can be a little bit misleading. So that's why we like cash dividend payout ratio. So total dividends paid divided by free cash flow. So are they earning enough to, pay out that dividend?
Whenever you can use free cash flow as a metric, I would advise doing so. Like you said, earnings can be manipulated. You've got interest, taxes, depreciation. You can manipulate those earnings to make the company look better than it really is. But when you get down to cash flows, you can't really manipulate that. And free cash flows, when you take out expenses, it is what it is. So that's a great metric to use to see how it's a conservative metric, but it does show you how healthy a company is.
Exactly. And then profitability, you want to be, I always say dividend investing is about investing in good businesses. Too many people focus just on the dividend. It's really about the quality of the management, quality of the business in general, and good ways to measure that are return on equity, return on assets, and operating margin. So not just net margin, because that can be a little manipulated as well, but what is the true operations of the business? What are they doing? when it comes to their margins. So make sure you're following those profitability metrics and make sure that they are consistent. Yeah.
Now, how do you avoid value traps? Now, the first thing that most people trip up on is they chase high yield. And what you have to always keep in the back of your mind is that above average yields, high yields compared to, say, treasuries, always means an extra level of risk. And as you ascend higher above what's called the risk-free rate, which is basically the 10-year treasuries, typically the proxy for risk-free rate, which is right around 4.5% now. You start getting up into the 8, 9, 10% yield plus category, especially on the equity side, you are taking high risk. And so what you want to make sure you're doing is not just falling in love with that current yield, because as we said before, dividends can get cut at any time. So you want to review the history of the dividend and its growth of that dividend, making sure that it is consistent and that it's not just a special dividend over the short term that's boosting that dividend yield or some sort of short-term factors with their business. And then you want to make sure that the balance sheets are safe. I mean, they aren't overburdened with debt. If companies are paying out a dividend and in order to do that, they're issuing debt and they're issuing shares. That's terrible. That's unsustainable. There's a lot of mortgage REITs that do this. It looks like they're paying a high amount, but basically they're just giving your capital back to you, and now you're paying taxes on that capital, if it's in a taxable account. So you really need to pay attention to the pitfalls and avoid these pitfalls that the vast majority of average investors make. So what you want to do is you want to focus on quality businesses, quality management, and you want to find businesses that have consistent operating cash flow. You want to make sure that their operating cash flow isn't drastically diverging from their quote unquote earnings, because remember, earnings can be manipulated to a degree. And so you want to make sure those are moving in line. And the history of their profitability metrics are consistent. And then how cyclical is the business? Remember, in a downturn in the economy or in a particular sector of the market, companies can just throw away their dividend. You get a new management team in, dividend gets cut, eliminated. And so how volatile is their business over time? You see this a lot in the commodities market. Well, we're relatively bullish on commodities. There's certain types that their earnings from year to year move drastically. And the steel industry is a good example. Some years, steel does fantastic, makes huge profits. The next year, they're losing money. So being cognizant of that is very important. And then are they returning capital to shareholders? Are they buying back shares? That's usually a prudent way to, a prudent thing for business, for management to do, is to consistently buy back the shares, especially if the shares are undervalued. And then industry analysis. So looking at competitors, the macroeconomic environment that they're operating in, and then disruptive threats. What competitors are out there that could wildly change their business model or disrupt their business model and take market share? And that's why some of the most boring businesses are the most consistent quality dividend payers, because the exciting sectors, ones that are interesting to most investors, they're the most competitive. Think of technology. Right? There's always a new competitor coming up trying to take the throne within the niche of their particular part of the tech space. Whereas, industrial companies, how much disruption is happening within the oil refining business, for example? Not that much. So making sure you're doing that industry analysis so you're not chasing after value traps that are under major pressure, whether that's from competitors or the macroeconomic environment. Here are the top dividend yielding sectors: energy, financial services, utilities, basic materials. And there are different metrics. And what's important here is to know that there's a lot of subsectors here. Energy, the dividend yield is really driven by coal. Coal's paying a high dividend yield. What oil's paying out a lot more, oil and gas. So their cash dividend payout ratio is pretty low, right? So they're only paying out 41% of their cash flow in dividends as a whole. And the return on assets is about 11%. Very healthy. Now, dividend yield on financial services is 6.1%, but that varies dramatically in the type of business you're talking about, whether a bank, Visa, MasterCard, etc. And the return on assets are very low because that's what banks typically are. They're fairly highly levered. That's why you see enterprise value of 18.4. There shouldn't be a percent sign, so there should be just numbers, but 18.4 times enterprise value to EBITDA. Utilities, they tend to be more consistent, low profitability because their profits are basically legislated in, because most of them are very regulated. There's not a lot of huge differences between the subsectors in the utility space. Basic materials, kind of like energy. Some subsectors are doing well. There's copper, there's steel, there's all different types of, there's gold, silver, there's all types of basic materials that are involved in that space. And so targeting the right sectors that have strong supply-demand dynamics is important as well. So I wanted to just give you that overview to see where you can get yield within different sectors. Let's talk a little about option income. Now, option income is somewhat complex, but it doesn't have to be, right? Options are a form of derivatives, and they can be misused. They're mainly used by speculators, and most speculators don't do great. Meaning, when you're buying options, you're more likely to lose money than make money. There can be big payoffs, but the vast majority of bets lose money. But you can take the other side of that, of the speculators, and you can sell those options, and that is a great way to get more income if you know what you're doing. You can certainly blow yourself up by selling options as well if you don't keep an eye on the risks. For example, if you're selling too many naked put options and the stocks go down dramatically, you can blow up your entire account. But if you keep it proportional, manage your risk, it can be good. Now, selling a call option is selling someone else the right to buy that stock at a certain price in the future. So all options expire on a certain date in the future. Put option is selling the right to sell the stock at a certain price in the future, expiring on a certain date. Now, there's naked versus covered. Naked is simply you don't own or short the underlying stock. You just sell the option. Now, if you sell a call naked and the stock price continues to go up, that can be a problem, right? Because if you say it's at 100, you sell $120 strike, and the stock goes to 200, you got to go buy it at 200 and deliver it at 120. You lost $80 per share there, and theoretically, it can continue to go up beyond 200. So, and the opposite is true with shorting a stock, right? You sell or selling a naked put, where you give someone the right to sell that stock to you at, say, 75. It's at 100 now, and the stock goes all the way to 25. Well, you got to sell it to somebody at 75. Or sorry, you have to buy it from them at 75. and now it's worth 25. So we don't recommend naked selling of options unless you're very risk controlled. Now covered, that's a bit different story. You're owning the underlying. So for that other example, it's $100 stock, sell a 125 call. You own the underlying. So if it keeps going above 125, no big deal. You own the underlying. It does cap your overall return, but that is more. That's easier to manage the risk. Now, this is why it's good to sell options and sell shorter dated options. So all options expire at a certain time, right? And if the expires a long ways away, there's still a lot of what is called time value in that option for the thesis of whoever buys it to play out. But as you get close to expiration, especially the last 60 and 30 days, the steepness of that option time decay increases exponentially. And you can see that here, where it's more of a consistent slope all the way up into that 60 days, and then it starts to really drop dramatically and very fast the last couple of weeks. So that's what we do. We try to sell between 30 and 60 days till expiration and capture a lot of this time decay. And so when you're selling options, you want to keep it relatively short term. Buying options, you want to go the opposite. You want that time decay to go away slowly, and you want to buy longer dated options. Now, this is an example of a cover call. So you buy $100 stock, sell $105 strike, you get $5 in premium, so your break even is 95. Now, most of the time, it's going to stay between, over the next month or two, it's going to stay between 105 and 95. Those stocks don't move dramatically. And so, say the stock goes nowhere, you collect a dividend, you keep that $5, and you came out ahead versus just holding it without selling the call option. Okay. Now stock goes to 105. You theoretically bought it for 95. You made $10 per share. Okay. So that's a simple example of what a cover call is. Now, what are the tips for selling cover calls? One is to roll the options monthly. Do not sell those long-term expirations, like I said. Keep the strikes between 5 and 10% out of the money. So with $100 stock, 105, 110, that's the area you want to stay in. Because you get good enough premium to where it hedges your downside, adds more income in the portfolio, but it doesn't cap your upside too dramatically. Number 3 is focusing too much on what are called implied volatilities, meaning you can go look at certain stocks that tend to move a lot, right? In the tech space, for example, and their implied volatility, the premiums you can get for selling options are very high. But just like chasing yield in the dividend market, it can be a fool's errand. And the implied volatility, the premium that you're getting, is elevated for a reason. And so that's why you want to focus more on owning the quality companies. Proper asset allocation, proper diversification. Overweighting the right and underweighting the right sectors. So make sure you're focusing once again on quality companies, not chasing those premiums. And then lastly, you don't have to get called away. Going back to that this example, say the stock goes from 100 to 110. You don't have to sell it for 105. You can buy that option back and roll it out the next month. There's nothing wrong with that. You don't have to get it called away. A lot of people get stuck with that. Oh, it's in the money. I have to sell it now for 105. No, not necessarily. Okay. Now the question is, what income opportunities are right for you? Well, that depends on your goals and your risk tolerance levels. Obviously, bonds are going to be more conservative. Dividend investing, if you're doing it right, is more moderate. Selling options, cover calls, moderately aggressive, right? So if you need help understanding which one's right for you, I encourage you to set up a portfolio review with myself. We review your goals and your concerns, break down the portfolio weightings and the risks that you're taking in your portfolio, and recommend which way to move. Whether that's into one of our income strategies, here's the 3, or it's doing it on your own. Either way works for us. We just want to help you make sure you're taking the appropriate level of risk to get the necessary level of income. That's what's important too, is understanding what is necessary based on your goals. Now, our various income strategies on the left, stable income, that's going to be a bond ladder of straight up corporate bonds. Very simple, straightforward. Those are typically for retirees who don't want a lot of volatility, want consistent income. Balanced income, that's going to be a blend. Dividend stocks, also ladder bonds, kind of that yin and yang of equities and bonds. But overall, you're getting consistent income and diversification. Now, Equity Income Plus, that one is our cover call strategy. Only dividend paying stocks, effective rotation, and moderately aggressive. So if you want to get in touch with us, just send us a message over on investtalk.com or kppfinancial.com. Both goes to the same site. You can give our office a call. This is our office where we're located in Irvine, or you can just shoot us an email at info@kppfinancial.com. I think that's it. I appreciate you all tuning in for this hour. Hope you got a lot out of it, and look forward to talking with you all again soon. Now, the next question will be, is how high can rates